Hello, everyone. So, since the budget day in the UK, which was early March, which feels like an awfully long time ago, there've been various loan schemes that have been announced with mixed success. So, loans in particular have been a particular area of criticism for the government, with the view in the media in the UK that not enough companies have been able to access the schemes. So in general, these schemes aren't haven't been perceived to be as successful for the furloughing scheme that Tim talked about, for instance. The schemes are continuing to evolve over the time, and one of the first scheme I'm actually going to talk about was one that was launched yesterday, and I think many businesses will say that that's been a good improvement. So, just going through the four main loan schemes that I'm going to cover today. The relevant schemes are generally set by turnover, although the first one isn't. The first one is the bounce back loan scheme. That's the one that was announced yesterday. For that one, the maximum loan size is £50,000. It's generally aimed at very small companies, but there are no company size restrictions. So in theory, a very large company could access that scheme, but because you can only access the maximum loan amount is 50,000. It probably isn't suitable for many. The next scheme is the Coronavirus Business Interruption Loan Scheme, or CBILS, as it's more snappily referred to. This one is for companies with turnover of up to £45 million, and the maximum loan size is £5 million. This was actually the first loan scheme that was announced. For companies bigger than that, there's the Coronavirus Large Business Interruption Loan Scheme. That's for companies that turn over between 45 and 500 million, and that scheme provides loans up to 50 million. And then the final scheme is the COVID Corporate Financing Facility. That's for companies that have turnover greater than 500 million. So firstly, as I said, we'll go through the most recently announced scheme, which is the bounce back loan scheme. The government has been under a lot of pressure here to underwrite loans by 100%, as is the case in the US and other countries. The UK government have limited the amount that can be borrowed, so that the 100% back loans are very much aimed at small companies. So this scheme was launched yesterday. As was the case with all the other schemes, all the other loan schemes, it's administered through a network of accredited banks. Businesses can borrow between £2,000 and £50,000, but the maximum amount that can be borrowed can't exceed 25% of turnover. The application system is designed to be very simple. It's a relatively simple application form which you would do for your bank, and then the aim is that the cash will be received within a few days of applying. The loan term can be up to 6 years, and for this particular scheme, this isn't the case for the larger schemes. The interest rate is set at 2.5% per annum. First year's interest and fees are paid for by the government, and there's no capital repayments in the first year, nor are there any early repayment fees if you do repay early. And the key point, as I mentioned earlier, was that 100% of the loan is guaranteed by the UK government, compared to 80% under the larger schemes. The key point is it's still a loan. This is not a grant, so the borrower is expected to repay these loans. In terms of the further eligibility criteria, so these are for businesses will be expected to self-certify that they've been impacted by coronavirus. You again will need to self-certify that you are not a business in difficulty as at the 31st of December 2019. You need to be in a business that is engaged in trading or commercial activity in the UK, and also was established by the 1st of March 2020. So for businesses which are the business can be foreign owned, can be owned by an Indian entity, for instance, but the business receiving this loan must be trading in the UK, or the majority of the business must be trading into the UK. You can't just be selling products into the UK. So the core operation of the business that is borrowing the money needs to be in the UK, and that's the case for the larger loan schemes too. The next criteria is that you aren't using any of the other larger loan schemes. Now, for instance, if you maybe previously had applied for the CBILS scheme, you can apply for a bounce back loan and use that to replace your CBILS loan. But if for instance you borrow 200,000 using the CBILS scheme, then it's highly unlikely you'll want to repay the 200,000 through that scheme and then borrow a maximum amount of 50,000 through the bounce back loan scheme. So you can only use one of these schemes. And the final criteria here is that the business needs to be deriving 50% of income from trading activity. So in terms of initial feedback, in the media yesterday, there were 80,000 applications by yesterday afternoon, compared to 53,000 over the past 6 weeks for the CBILS scheme. Barclays very proudly announced that they'd approved 100% of applications in the first hour, and had approved 6,000 loans, totaling 200 million by midday. So it does look like the response rate on this has been very positive, but we'll see how that continues. So the second scheme was the one that was actually the first one that was announced first, and has probably been the most controversial of all the schemes, with a lot of businesses complaining about not being able to access it. At the end of last week, I think £4 billion had been approved for the scheme. Now, if you compare that to the total amount in the US scheme, which is in the hundreds of millions of dollars, it sort of puts into perspective puts that figure into perspective a bit. So the CBILS loan scheme is intended to provide financial support to businesses that have seen their cash flows disrupted as a result of the outbreak. It's administered through the major high street banks, and unlike the bounce back loan scheme, it gives the lender a guarantee of 80% of the value of the loan, and that's very much to encourage the bank to lend. It's not to underwrite the loan to the business. So the borrower remains fully liable for the debt, but if the borrower defaults, then only the 20% outstanding facility can be recovered using any security and any personal guarantees given. In terms of eligibility criteria, it's quite similar to the bounce back loans in terms of its the criteria for it being a UK based business activity. In terms of the criteria, in terms of viability tests, these are slightly more stringent. So under the bounce back loan scheme, I mentioned that the criteria was that it wasn't a business in difficulty at 31st of December. So you have to that is a criteria for this again, but more importantly, you need to prove that you were a viable business and one that would have been able to support debt prior to the pandemic. This next point is one that's actually changed. So initially, and up until I think about a week ago, the requirement was that you need to evidence that you can that you expect to be able to return to profitability in the future. Now banks are being told they can't ask for future information. From my conversations that I've had with bankers over the last week, what they're doing is they're recommending that if you have forecasts which support your application, so which demonstrate that you expect to return to profitability, then this will only improve the likelihood of you being able to borrow. But it's not something that the banks can any longer request for as part of the information requests. And finally, the final point is generally formal due diligence is not being carried out by the banks, so they won't be sort of requesting that a accounting firm just due diligence on the numbers. They'll be doing that internally themselves. So they'll be looking at your historic numbers and current trading, and then if you supply forecasts again, they'd be looking at that internally. But I'll be moving on to the information that is required a bit later on. So in terms of the maximum loan facility for this scheme, it's £5 million. The maximum facility is £5 million for businesses with up to £45 million of turnover. Similarly to the Bounce Back loan scheme, the facilities can be taken out over a period of up to 6 years. There are also 4 different types of facility that can be offered as part of this scheme. So term debt and asset financing facilities, those are the ones which can be repaid over 6 years. Overdraft and invoice financing facilities can be in place for up to 3 years. And similarly, as was the case for the Bounce Back loans, the arrangement fees and interest for the first 12 months will be paid for by the government. Mentioned briefly security earlier. So personal guarantees cannot be taken if the loan is for less than 250,000. The primary residential property of a guarantor can't be taken as security, but in the event that there's in the event of a default and the bank are pursuing you for the final 20%, if no other assets are available, then it may come into play. It just can't be. It just can't be specifically used as security. And yeah, the final point is that it's the amount that's taken as security is limited to 20% of the 20% of the total facility. So the government underwrite the first 80%, and that's been a change since the scheme was announced. Next scheme, which was one that was introduced a few weeks ago. So this scheme was aimed at businesses that were too big for CBILS, but then not big enough to be able to access the larger corporate financing facility. Is the large business interruption loan scheme. Very similar criteria. Major differences are there's a £25 million facility limit for businesses up to 250 million turnover, and a facility limit of 50 million for those between 250 and 500 million. There's still the 80% guarantee from the government, and one major change or one major difference is the interest and arrangement fees aren't covered by the government for this scheme. So the businesses will be paying the interest and arrangement fees to access this scheme. There's only a few high street a few of the lenders that are able to offer this scheme. Which is generally the major high street banks. And from conversations I've had so far, it seems that due diligence is being carried out by quite a lot of the lenders, depending on the circumstances. If you're applying to your bank and you've been with your bank for a number of years, then they may not carry out due diligence. But if they've got less information about you, then it's quite likely that they will carry out due diligence. And just one final point, actually, that I didn't mention about all three of these schemes is it's generally best if you apply through your own bank initially. You'll probably have the best chance of success through your own bank. In terms of the information required, so this does vary depending on the scheme, and it is evolving. But I think you can expect to be asked for the following information. So firstly, you need to be able to prove historic viability. So this will be the case for all three loan schemes. So for this, you'd be asked to produce accounts. Now for the CBILS scheme and this the large scheme, the banks will be doing a lot more work on this to check that you would have had the cash flow in place to actually be able to support debt historically. Whereas for bounce back, the information, if information is required, it's just to check that you weren't in difficulty as at the 31st of December date. For these the CBILS and the CLBILS, then banks will also be asking for you to look at the current needs of the business. So this is to show whether you need the money and also how much you need. A good thing to do is very much to model your potential funding shortfall over the coming months and assess how much you may need using cash flow modeling, taking everything into consideration. Just as a general point, I'm sure many of you are already, but a good thing to do is to be using a constantly refreshing a 13-week rolling cash flow statement, as they're very useful tools to be using in times like these. Then the final point is that you'll be asked to evidence the future needs of the business. So, and whilst this isn't the case necessarily whilst you don't need to provide this for the bounce back schemes or necessarily for the CBILS schemes, this is a debt and it's not a grant. So it's probably very useful for you to assess how long this is actually going to take you how long it will take you to repay this debt. So what's a good thing to do is probably for the next 12 months, then think about clearly think of what the downturn is going to look like, but then start to think about what the recovery could look like for your business, and then what this debt repayment will have on your future profits and cash flows over the coming years. And particularly what it might leave you to then pay out in dividends at the end. This information is absolutely vital for the CLBILS, for the large scheme, and banks will be asking for a very detailed model. Bank I spoke to on Friday said generally they'll be asking for this to be produced with on two bases. The first basis based on current assumptions, the second basis based on what the business would look like and what the cash flows will look like if the lockdown and if this crisis continues for say another 6-9 months, to sort of give to provide what the worst case scenario could look like. As I mentioned earlier, for the CBILS, banks are no longer asking for for this information. But as I said, if it supports your application, then you should include it. So the final scheme that I'm going to cover today is one called the Future Funds. So this scheme was announced sort of 2 or 3 weeks ago. It's not actually been launched yet. But the issue that a lot of sort of early stage tech and venture capital backed companies in the UK found was that they're ineligible for any of the loan schemes, as technically they couldn't demonstrate viability prior to the crisis, as they were loss making. So that meant the government were under a lot of pressure to provide a solution, and so the solution that has been launched is the Future Fund. And so this is intended to provide support for high growth startups for whom can't access the previous loan schemes. Information is still coming out, and I think it's still being worked out ahead of its launch in a few weeks' time. But generally, how this will work is the government will put in an amount between £125,000 and £5 million in the form of convertible loan notes. These need to be the amount put in by the government needs to be matched by a third-party investor. These loan notes will then convert into equity at the end of their term, which is up to 3 years' time, or at the date of the company's next equity fundraising round. The interest rate on this is 8% or higher, depending on if the matched investors request a higher interest rate. To access this scheme, the company must be UK registered and unlisted, and it must have raised at least £250,000 from third-party investors previously. For this scheme, there's a few terms that for what the money can be used for. It's very much for working capital purposes. It can't be used to repay debt, fund dividends, or pay any advisory fees. We'll find out more over the coming weeks how successful this scheme is, but I think our initial concerns are whether investors will want to co-invest alongside the government, particularly as there are rules in the scheme which dictate the price that this will convert at in the future. Additionally, I think timing is quite important. So equity fundraising, particularly if you're going to the VC and mid-market PE community, can take up to 5 months. So will this actually be fast enough to help startups? I think my view is that this is quite suitable if you've got a wealthy private investor who's willing to who can quickly put money in alongside the government. But I think for the VCs, it remains to be seen whether this scheme will be that effective. So that's the end of my slide. So I'll now